Have you ever wondered how traders predict the stock market? It seems like magic, doesn't it? But in reality, it's a science, a game of patterns and probabilities. Traders often rely on technical analysis, a method of evaluating investments by analyzing statistical trends gathered from trading activity. Two key patterns that traders often use to predict the stock market are the golden cross and the death cross. These patterns, as ominous or promising as they sound, are formed by moving averages. They're not about divination or prophecy, but about spotting potential shifts in the market before they happen. Mastering the recognition of these patterns can be a powerful tool in any trader's arsenal. But, you might wonder, what exactly are the golden cross and death cross? What makes them so important in the world of stock market predictions? Let's unravel these mysteries. Stay tuned as we delve deeper into the magic of stock market predictions. Imagine the stock market as a busy highway with cars moving at different speeds. The golden cross is like a speed sign indicating that it's time to speed up. In the world of stock markets, the golden cross is a term that you'll often hear. It's a bullish signal, indicating that it might be a good time to buy. But what exactly is a golden cross? Let's simplify it. Think of a golden cross as a specific moment in time. This moment occurs when a short-term moving average crosses above a long-term moving average. Now let's break that down. Imagine you're at a racetrack observing two runners. One is a sprinter, representing the short-term moving average, and the other is a marathon runner, representing the long-term moving average. At the start of the race, both runners are at the same line, but as the race progresses, the sprinter runs ahead. In the context of the stock market, the sprinter represents the recent market prices, while the marathon runner represents the older, more stable prices. When the sprinter crosses the marathon runner, it's a sign that the market is picking up speed. This is the golden cross. Now, why is it called a golden cross? Well, it's because this crossover usually signals a bull market on the horizon, and as we know, bull markets can be a golden opportunity for investors. However, like all signals, the golden cross isn't foolproof. It's just one of many indicators that investors use to gauge market trends. It's also worth noting that a golden cross is more significant when accompanied by high trading volumes. This is akin to our sprinter crossing the marathon runner with a crowd of other sprinters. The more sprinters, the stronger the signal. So in essence, the golden cross is a signal that the market's momentum is shifting from bearish to bullish. It's like the market is saying, hey, things are looking up, it might be a good time to invest. So when you see a golden cross, it's like the market is giving you a green light to invest. Now, let's switch gears and talk about the death cross. Think of it as a warning sign on our highway, telling you to slow down. Picture yourself cruising down a highway. The sun is shining, the wind is in your hair, and your favorite tunes are blasting from the car's speakers. Suddenly you see a warning sign flashing up ahead. It's telling you that there's a major roadblock or a potential hazard on your route. The death cross is that warning sign in the world of stock market. It's a bearish signal, which means it's an indication that the market may be about to take a downturn. This signal occurs when a short-term moving average crosses below a long-term moving average. Imagine you've been tracking the average price of a stock over the last 50 days, and you've also been watching the average price over the last 200 days. Most of the time, the 50-day average is above the 200-day average. This is because recent prices, which are included in the 50-day average, are usually higher due to inflation and growth. But what happens when the tables turn? What if the 50-day average drops below the 200-day average? That's when you have a death cross. Think of it like this. You're a farmer watching your crops. If the recent weeks have been sunny and warm, your crops are probably doing well. But if the weather turns cold and rainy for enough days in a row, your crops might start to wilt. The death cross is like a forecast that's predicting a lot of rain. So what do you do when you see a death cross? It's not a surefire prediction of a market downturn, but it is a red flag. It's a signal to traders that they might want to reevaluate their positions. If you're an aggressive trader, you might want to sell some of your shares. If you're a conservative investor, you might want to hold off on buying more shares until the storm has passed. So a death cross is like a red light, warning you to be cautious or even to pull out of the market. You might be wondering, how can I use these signs to my advantage? Well, it's all about timing and strategy. Let's delve into the practical application of the golden cross and death cross in the world of trading. Traders often use these patterns as signals to make informed decisions about buying or selling stocks. When a golden cross appears, It may be an indication to buy or hold a stock, as it signifies a potential upward trend. Conversely, when a death cross is spotted, it could be a signal to sell or short a stock, as it might suggest a downward trend is on the horizon. However, it's important to note that these are just tools, not absolute predictors of market behavior. They should be used in conjunction with other indicators and market analysis techniques. For instance, consider the overall market conditions, the performance of the specific stock over time, and other technical indicators like the relative strength index before making a decision. Moreover, these patterns can be influenced by the time frame of the moving averages used. Shorter time frames might have more frequent crosses, but they might also result in more false signals. On the other hand, longer time frames might give fewer signals, but they could be more reliable. Also, patience is key. Acting too quickly on a golden cross or death cross without waiting for confirmation might lead to premature decisions. Often, it's wise to wait for the stock price to show a definite trend following the cross before making a move. And finally, always have a risk management strategy in place. No matter how compelling a golden cross or death cross may seem, they can't guarantee success. It's crucial to have a plan for managing potential losses. Remember, the golden cross and death cross are not crystal balls, but they can offer valuable insights into market trends. They serve as guides, helping you navigate the often turbulent waters of the stock market. But ultimately, the success of your investments will depend on a well-rounded strategy and informed decision-making. So, what should you remember about the golden cross and death cross? Firstly, the golden cross and death cross are technical indicators used by traders to predict potential major shifts in the stock market. These tools are not crystal balls, but they can give us valuable insights into market trends, allowing us to make more informed investment decisions. The golden cross occurs when a short-term moving average, typically the 50-day moving average, crosses above a long-term moving average, often the 200-day moving average. This cross is seen as a bullish signal, indicating that upward momentum may be building and it might be a good time to buy. On the flip side, the death cross is the exact opposite. It happens when the short-term moving average crosses below the long-term moving average. This is viewed as a bearish signal, suggesting that downward momentum may be on the horizon, and it might be a good time to sell or short a position. Remember though, these signals are not foolproof. They are based on historical data and do not guarantee future performance. They are best used in conjunction with other technical and fundamental analysis tools to confirm trends and minimize potential risks. Both the golden cross and death cross serve as indicators of major trend reversals. They can provide early warnings for potential bullish or bearish market shifts, giving you the opportunity to adjust your investment strategy accordingly. It's also worth noting that these crosses are more significant when accompanied by high trading volumes. A golden cross or death cross with low trading volume can often be a false signal, so always consider the trading volume when interpreting these signals. In conclusion, understanding these two technical indicators, the golden cross and the death cross, can significantly enhance your trading strategy. They offer you a way to spot potential trend reversals, helping you to make more informed and potentially more profitable investment decisions. With these tools in your trading toolbox, you're one step closer to navigating the stock market highway with more confidence. Happy trading!